Many people think that investing is only for the rich, but the truth is anyone can start investing, even with very little money. You don't need thousands or tens of thousands of dollars to begin. You can start today with as little as $20 or $50 a month. In this video, I will walk you through everything you need to know to start investing with small amounts, build good habits, and grow your money over time. The most important thing about investing is to start saving regularly. Even if you start with just $20 per month, that is enough to begin your journey. The goal is to create a habit of putting money aside every month. You can set up an automatic transfer from your checking account to a separate savings or investment account. Automation helps you stay consistent and removes the temptation to spend the money. Remember, consistency beats timing the market. Once you have started saving regularly, you will need to choose a platform to invest your money. Today, there are many easy-to-use platforms available online. Some of the most popular platforms include eToro, Trading 212, XTB, and Robinhood, depending on your country. When choosing a platform, pay attention to fees and commissions, minimum investment amounts, and the types of investments available. Many platforms now offer fractional shares, which means you can buy a portion of a stock or ETF, even if you don't have enough money to buy a full share. Also, make sure the platform is regulated and trustworthy. As a beginner, it is best to start with simple, diversified investments. One of the best options for small investors are ETFs, or exchange-traded funds. ETFs are baskets of stocks or bonds that you can buy like a single stock. This allows you to own a small piece of many companies, which helps reduce risk. Popular ETFs include the S&P 500 ETF, which tracks the 500 largest companies in the US, and the MSCI World ETF, which tracks global stocks. Investing in ETFs helps you spread your money across many sectors and countries, reducing the risk of any single company's failure. If you want to invest in individual stocks, pick companies you understand and believe in, but keep in mind this can be riskier. One of the best strategies for beginner investors is called dollar cost averaging, or DCA. This means investing a fixed amount of money regularly regardless of the market's ups and downs. By doing this, you buy more shares when prices are low and fewer shares when prices are high. Over time, this can lower your average cost per share and reduce risk. DCA helps you avoid trying to time the market, which is difficult even for experts. Staying consistent with your investments is far more important than trying to pick the perfect moment. Investing is not a way to get rich quickly. It is a long-term game. The true power of investing comes from compound interest, earning returns on your returns over time. For example, if you invest $50 a month and earn an average of 8% annually, in 10 years you could have over $9,000. If you keep investing for 20 or 30 years, your money can grow significantly more. The key is patience and sticking to your plan, even when the market goes down. Remember, market downturns are normal and often create buying opportunities. Many beginners make mistakes like trying to time the market, chasing hot stocks, or selling in panic during market drops. Avoid these mistakes by staying disciplined. Don't invest money you might need soon. Keep an emergency fund separate from your investments. Educate yourself continuously, but don't get overwhelmed by too much information. Focus on simple, proven strategies. To summarize, start small, be consistent, choose the right platform, invest in diversified assets like ETFs, and think long-term. Investing with little money is possible and smart. The key is to start now. If you found this video helpful, please like, share, and subscribe for more tips on personal finance and investing. Your financial future starts today.